Welcome to the Allan Small Financial Show. Thank you once again for taking time out of your busy day to share with us in this broadcast. I also want to thank everyone for waiting an extra week. I know we like to do the show every 2 weeks. Fortunately, I was away from the office last week and so excited to be with you, all of you, this week. So we took one extra week. And keep in mind, we do this show to get the information to all of you, to answer all your questions. So if you have any questions during the broadcast, please feel free to send them in to us through YouTube, Facebook Live. Love to be able to answer your questions or comments at the end of the show, which is always my favorite part of the show. But we do this show to really get information out to everyone. What's pertinent to know? What should you be looking at and considering when you look at your portfolio statements every month? So this is the time where I want to go to everybody live right across the country and talk a bit about what I think is important for individual investors to consider and to understand, especially when you're looking at your statements that you receive in the mail every month. So what's on the show today? We're going to speak a little bit about rising rates and the effects they're having on the GIC and bond market. I've been getting a few questions regarding that lately. Are these now viable investment ideas for individual investors? We're going to talk about the This Week part of our show. And This Week is a segment we do all the time where I talk about what individual investors need to consider before they make their investment decisions over the next 5 to 10 business days. We're also going to talk about, has the investment strategy, or should your investment strategy, should it have changed over the last 5 to 6 weeks? We've seen a huge turnaround in the stock market. Has your investment strategy changed as well to match the turnaround in the stock market? We're also going to talk about technology stocks. This turnaround that we've been seeing has been led by technology predominantly. Should you be looking at some tech names, or are these names starting to become a little more expensive lately? And lastly, we're going to look at your questions once again, answer the questions that you may have regarding the market, perhaps regarding your individual portfolios. I'm always happy to answer any questions and comments you may have. So for the most part, we've seen a pretty large and significant rise in interest rates, really for all of us, over the last 6.5, well, I guess I should say 7.5 months now. Since the start of the year, it's basically taken our variable mortgages up significantly. It's taken our line of credit interest that we're paying up significantly. But it's also taken up GIC rates and bond rates, government bonds, corporate bond rates. And so no wonder I've been getting a number of questions from individual investors asking me, are these now viable investments? Meaning, can we now start adding these investments? Should we start adding these investments into our portfolios today? If you look at where GIC rates and bond rates are right now, you could easily obtain a rate in the 4.5% range on an annual basis, or even a 5-year. You'll find that the interest rates aren't much different. You're getting paid pretty much on a 5-year rate, which you're getting on a 1-year rate. There's not really much difference. Corporate bonds are paying that as well, somewhere in that 4.5% on an annual basis. Again, depending on a 1-year bond, 5-year bond, 3-year bonds. So are these investments now right for individual investors? Well, as you probably would imagine, or again, I imagine I would say, my answer to that question would be, it depends on the investor. It depends on who you are. What are you looking for? If you're looking for growth, you're probably still not looking at bonds or GICs right now. Bonds and GICs, yes, even though they're paying significantly higher than they were just 7 months ago, with inflation at around 7-8%, earning a 4% rate really doesn't cut it. You're still looking at a negative 3% rate when you factor in inflation if you were to obtain one of these GICs or bonds. So you're not really getting any growth for that type of investment. When you look at GICs, I get a number of individuals asking me, Allan, should I be buying GICs versus bonds? Because GICs are guaranteed by the government. And the answer I always give is, that's a very difficult one. First of all, The guarantee is up to $100,000 per GIC. Secondly, and probably most importantly, that GIC is not flexible. When you buy it, you're stuck there for that duration. If it's a 1-year GIC or a 5-year GIC, unfortunately, most banks will not allow you to break that GIC and take your money back out if you were to need it or require it for something. So flexibility to me is probably one of the most important things that as an investment advisor for my investors, having the flexibility to access your money when you want it. If you were to buy a bond instead of a GIC, bonds are actually traded every day. So there's a price attached to it. So if you want to access your money, you can always sell that bond. If it's a Royal Bank bond, so a very good quality corporate bond or a government bond, they're usually, or I would say there always is a market for those bonds, and you can get out. Now, of course, you would have to get out at the going price, and that may be lower or higher than when you bought it, but you can definitely access your money. Whereas GICs, there is no price attached to it. You just give your money to a trust company, a bank, or a credit union, and they give you basically a little piece of paper that says they will give you your money back in 1 year or 3 years or whenever it matures. And the agreement is that they will pay you a set interest rate every year for owning that GIC. So overall, when you look at bonds and GICs, I think it can be part of a diversified portfolio, the part of a portfolio that you kind of want to park your money in, the part that you want as a low risk side of your money, something that's going to pay you in that 4% range, understanding that it's not going to provide you much growth or any growth at all, actually, but it's going to provide you that security, something that you're able to sleep at night with, that security blanket. And I think that's what and why you should own bonds and GICs today. If you're looking to park your money and earn a slightly better rate than you would earn in a high interest savings account, these investments are now becoming more and more of an opportunity or a part of people's investments if they just want that security. So yes, I think bonds and GICs can be a part of a diversified portfolio. I would look at bonds more so than GICs from a flexibility standpoint. And so that's what I would say to anyone who is interested and curious as to if fixed income should be a part of their portfolio today. Welcome to the part of the show where I discuss what I believe is important for individual investors to understand or consider over the next 5 to 10 business days before they make their investment decisions. I'm going to touch a bit upon inflation and inflation data. I'm also going to talk about the Fed. What are they saying? The Federal Reserve in the United States, they are really the be all and end all for interest rates around the world. Everybody looks to the Fed to set monetary policy, to set the interest rates for the United States, which all the other countries feed off of and compare their rates to. The Federal Reserve actually at 2 p.m. this afternoon is going to be coming out with their minutes. And in those minutes, they're going to talk, or we'll see what the Federal Reserve or the Board of Governors were speaking about at their last meeting when they raised interest rates 75 basis points. So I think looking at the Fed and inflation is important. We're also going to talk about how many bargains are still out there today for individual investors to consider. Once upon a time, there were quite a few. Today, maybe not as many. And lastly, price of oil. I think individual investors still need to have one eye on the markets and one eye on the price of oil, because the price of oil, as we're learning, is so crucial to inflation, interest rates, and the overall markets in general. So let's start talking about the inflationary data that we've seen recently. As many of you may know, recently, we've actually we saw a tick down in inflation. Inflation in the United States was over 9%. Now it's somewhere around 8.5%. In Canada, over 8%. Now it's somewhere around 7.5%. And that really gave a jolt or some adrenaline to the stock market when those readings or data came out, and the market really started to move higher. If we begin to see that this was just a one-shot deal, that this was just 1 month data, we all know that 1 month does not make a trend. So if the next time we see inflationary data come out and it's back up again, I think this will be a very big negative for the stock market. I think a lot of people are looking at inflationary data starting to continue to trickle down towards that 3-4% range at some point over the next year or so. I personally think it's going to take a little while before we see inflation hit the target of the Fed, which is 2%. It may take a few years, as we know that wage inflation is very sticky. We're seeing higher wages out there. We're seeing price of food, price of groceries, really the price of rent, cars, everything has been going up. And I think it's going to take a while before we see that inflationary data take lower or significantly lower. But I think we need to keep an eye on the Fed, the Bank of Canada. I know the Bank of Canada recently said that they're going to have to continue to attack inflation with higher rates going forward. And if they continue to say that, the Bank of Canada and the Federal Reserve continue to raise rates, what does this mean for the overall economy? Unfortunately, I think the economy will continue to be volatile in this type of environment. Secondly, I want to talk about bargains. Do we still see bargains in the market? And when you make your individual investment decisions, what are the bargains out there? Well, I think about maybe 6 weeks ago, you probably could have closed your eyes and pick a sector, and there would have been probably at least half a dozen to a dozen stocks on sale. And I think a lot has changed in the last 6 weeks. We've seen the NASDAQ rebound significantly. So there aren't as many bargains as there were before. To me, all that means is you got to do your homework. You really have to analyze these businesses and to see if you're going to look at buying their shares or their stock. And it's not as simple as, well, figure out what's fallen the most and then buy that stock. Doesn't always work that way. There have been a number of stocks that have fallen in value that haven't come back up as yet. There have been a number of stocks that have fallen in value for good reason. They actually fell before we started to see the inflationary data tick higher and the higher interest rates. You know, a name that comes to mind is Netflix. I think Netflix, I've been asked about Netflix quite often. I think a name like Netflix, unfortunately, had their problems before we had this higher interest rate environment. So not all names, just because they've fallen quite a bit and present a bargain to individual investors, should be bought. I think you really have to do your homework at this time. I think a lot of the bargains, the Microsofts, the Apples, I think Apple's only down 2% for the year right now. That's how much it's already come back. At one point, I would have said it was a big bargain. So really look for those bargains that still exist today and understand why they're still a bargain. Perhaps it's for good reason and you may not want to own it, but look for those names that are still a bargain and that you feel will rise over the coming weeks and months. Lastly, oil. I think oil is so crucial to this market. I was speaking to some people before we came on air, and we were talking about how oil prices could have added, or the increase in oil could have added maybe as much as 50% to the inflation rate, that it's boosted it 50% higher. Perhaps oil prices, if they were at $75, $80 a barrel, we may not have seen inflation at 9% in the US or 8% here in Canada. Oil prices prior to Russia invading Ukraine were somewhere in the mid 80s. And if you look at oil today, we're about $88, $89 a barrel, in that range. I think maybe tick down today a little bit. So we might be around $87 a barrel. So all the premium that was built into the price of oil that came after Russia's invasion of Ukraine has come out of the market. But we've seen oil spike all the way to 120, 130, and now back down again. And it's probably no coincidence that you're seeing inflation data start to fall as the price of oil falls as well. So as investors, you want to obviously, as I said, look for good bargains, look at the stock market, understand what the Federal Reserve and Bank of Canada are saying, but you also want to look at the price of oil. If Iran are able to start to produce oil for the rest of the world, if sanctions are removed and they can now sell oil, that could be as much as 1 million barrels a day back online. That could help bring the price of oil down further. We know the US is producing oil between 12 million and 13 million barrels a day. They actually reported a higher inventory of oil, this last report that I saw in the last couple of weeks. So the rest of the world is trying to make up for the loss of oil that's come out of Russia. Hopefully, we can continue to do this. And as we move into the colder months, the hope is that Europe, United States, Canada, Western world, as we call it, will be able to make up for the loss of natural gas and oil that we're no longer getting or receiving from Russia. So keep an eye on oil prices. They are crucial to how this market behaves. So my investment strategy, I think, has actually changed a little bit in the last 5 to 6 weeks. I went from being pretty aggressive at the end of June when I saw that when companies were reporting earnings, that even though they may have been weak, I started to see some of these stocks not fall as much as they would have fallen earlier in the year. I use the example of JP Morgan as an example. I think JP Morgan reported really soft earnings, and I think the stock went down $1 or 1-2%. Had they reported that weak earnings back in March, they probably would have fallen 10%. So when I started to see that things were sort of priced into the market, priced into some of these stocks, that's when I began to buy aggressively. Well, here we are today, 6 weeks later, since the bottom, what I believe was the bottom of the market at the end of June, and my investment strategy is changing once again. I still remain in growth mode or positive on the markets. I have said all along to many individual investors that the second half of the year would be positive, and so far so good. Keep our fingers crossed. But I think now you have to be a lot more stringent, as I said earlier on the show. I think you need to look for bargains, but I think you need to be a lot more constructive, a lot more diversified. I think, I guess there was a little time there where I started to emphasize certain investments, put a little more money in certain sectors of the markets, of the economy. Now I've started to back away a little bit, kind of keep broadening, stay diversified, continue to look for those bargains that are going to provide my clients with growth, if that's what they're looking for, or income, if that's what they're looking for. But I'm noticing now that a lot of those high dividend payers are paying less because their stock price has gone up. I'm looking at a lot of the bargains that we used to have. They're not as on sale as they once were because their stock prices have gone up. So I think overall, my strategy, I guess if I was going to talk about being aggressive, I think I was a little bit more aggressive beginning of July, still wanting growth today, obviously, but perhaps a little less aggressive mid-August. I still think there are a lot of great quality companies out there to own, but not as aggressive to go after those companies, especially if their prices have gone up. Technology stocks, one of my favorite sectors. I think technology has led the way for this market back. We've seen the Nasdaq, basically make back about half the losses that they had in the first 6 months of the year. We've seen tech names like Apple, as I mentioned earlier, only down 2% for the year. Names like Microsoft have rebounded, Amazon, Google, even names like Meta or Facebook. We've seen a bounce back, and some of the chips like an AMD, which I've spoken about on this show before. Technology has led the way back. Does that surprise me? Not really. Technology makes up the biggest part of the S&P 500, the biggest index in North America. So if we're going to see a market surge higher in general, it's going to be led by technology. Technology makes up about 40-45% of the overall market. So I continue to look for technology exposure to my portfolios as I'm building them for individual investors. As you all know, I build individual portfolios from scratch from everyone that I meet on a daily basis. And technology is a big part of that. Owning some of these big cap tech names is crucial. I think you must own them going forward, even though, yes, they have bounced back and maybe they're not on sale as much as they were 6 weeks ago. I still think you need to own some of the names that I've just mentioned as part of a diversified portfolio, along with bank and retail and pharmaceutical and even a little bit of oil, etc. So technology, look for tech to continue to lead the way. I think it has to if we're going to see the markets in North America continue to move higher over the course of the next 5 months until year end. So this is the part of the show where I get to answer all your questions, answer any questions that you may have. And if you're watching today, you want to ask a question, please put it into the message area on YouTube, and I should get it pretty quickly, and I'll be able to answer it right away. If anyone wants to ask any questions after the show, perhaps you're watching this show taped on my website or anywhere that you might see it, and you have a question for me, feel free to email me. I'd love to be able to answer all the questions that anybody might have regarding the topics I spoke about today, or anything else that may pop into your minds about investing in general or your individual portfolios. So let's see what questions we have today. Question here: the market volatility this year has been freaking me out. Great way to put it. How, as an investment advisor, do you deal with this for your clients? Are you always rebalancing your clients' portfolios or staying the course? Well, the good news is I don't freak out. I've been doing this now for about 25 years. And so been through a lot of ups and downs in the market. We've been through COVID recently. This year was a tough start to the year, the financial crisis. We saw a downturn at the end of 2018, Greek crisis when they couldn't figure out if they could pay their debts, U.S. getting their debt downgraded from a AAA status to a AA status. We've seen it all in the last, I'd call it 25 years. So tech, not to forget the tech bubble bursting at the end of the 90s, 2000. So I don't freak out, no. I do constantly rebalance portfolios if there's a need to do that. Again, it all depends on the individual investor. What's their time horizon? Are they looking for growth? Are they looking for income? What is their risk tolerance? These are all things that play a part in the rebalancing of a portfolio. I like to look at my clients' portfolios as often as I can. And as many of you know already, every 6 to 8 weeks, if nothing pops up before that, a red flag or something that I need to look at sooner, if everything is all status quo and calm, I'll look at portfolios every 6 weeks or so and communicate to clients if I need to make a change, I need to restructure, maybe there's a new investment idea to buy. So constant contact, and that's when I'll make a recommendation to perhaps make a change or rebalance a portfolio, take some profits. And I've been doing a lot of that over the last couple of months, as you all know, trying to take advantage of the bargains that have been there. So yes, I often restructure portfolios, especially in volatile times, but again, only if they need to be restructured and changed. Let's take another question here. I'm getting very close to retirement and the value of my portfolio has decreased this year. What advice are you giving to people in my situation who are worrying about whether or not they can retire? That's a difficult question. I think everybody is nervous about not having enough money when they decide to retire. And here we are, we've had great markets for so long. And all of a sudden we come to 2022, in the first 6 months, we see a pretty big negative number. NASDAQ was down 35% at one point. The S&P 500, negative 22, 23%. TSX, I think, got down as much as 15, 16%. So that's enough to scare people, especially as they approach retirement. And so, well, I guess you could look at my approach to this in a couple of different ways. Number one, again, who is the investor that I'm talking to? Are they more risk averse? If they are, perhaps they should start to reduce risk as they get closer to that retirement age, keeping in mind that even in retirement, you're going to stay invested for years to come. People have this misconception that, as I get closer to retirement, I don't have enough time to make back any losses that I may incur in the last few years before retirement. And that's not true. I don't know really many people that take out all their money out of their RSP in one shot or take out all their money from their investments in one shot to live off of. You're going to take out what you need gradually over time, and the rest of it stays invested. So maybe for those of you watching today, maybe I hate to say it, but you're going to be an investor probably to the day you're no longer with us in some capacity, whether you're in stocks or bonds or GICs, if that's what you want, or mutual funds, you're going to be invested really for the rest of your life. And so don't be afraid of this ticking time clock, getting close to retirement. Yes, you want to make sure you have enough money to retire. And if that still means that you need to grow your portfolio, then unfortunately, you're going to have to stay in this stock market, and you're going to have to, unfortunately, withstand some of the volatility. But overall, we'll do our best at the Allan Small Financial Group to limit that volatility, try and do better than the overall markets, to the peaks and valleys, to limit those peaks and valleys, to make them smaller so that the road is less bumpy. And I think that's what you want to do. And I think that's what individual investors should look to be doing. Again, if you're one person that even in retirement, you're okay with the volatility and you still want growth, then that's great. If you're someone that is concerned or nervous about volatility, then maybe we scale that down a little bit. But I still think you need to have growth investments even in retirement. Let's see here. Third question. I know we're getting close on time. I often hear about low risk investments and high risk investments. Can you please explain what these are and give examples of what they may look like? Should you avoid high risk investments? Again, I always say it's up to the individual investor. Should you avoid high risk investments? Well, if you're an investor that can tolerate significant ups and downs in the market, then no. I think you can have high risk investments as a small part of your portfolio, understanding that you can make a lot of money, but unfortunately, you can lose money as well, just as quick. Today, there are a lot of medium risk investments that I think some people would call high risk, but they're considered medium risk. And I think being in a medium risk portfolio with interest rates the way they are, with the stock market behaving as it has over the last few years, I think medium risk is just fine for individuals to go into for growth. I don't think you need to take excessively high risk in penny stocks or cryptocurrencies and all that. I think you can have that as a very small part of a diversified portfolio, but your core growth portfolio should be made up of good quality names, good quality investment ideas, and those investment ideas are usually medium risk. So medium risk versus high risk has everything to do with volatility. And as I said, the peaks and valleys. A medium risk investment today, expectations should be probably, if you have a medium risk portfolio, maybe in that 7, 8 to 10% range on the upside. On the downside, maybe an average loss of 5 to 7%. So that's kind of your goalpost, if you will. Last year, for example, medium risk portfolios made a lot more than 7 to 10%. This year, medium risk portfolios lost a lot more in the first 6 months than 5 to 7%. So even though I'm giving you these ranges, these are just general ranges, averages. And we know sometimes numbers fall outside the averages, but over the long term, they always revert back to the mean or to the average. So if you're in a medium risk portfolio, yeah, I think if you're looking for growth, conservative growth, 7, 8 to 10% should be the expectation. Setting expectations is what is most important. And higher risk, sure, you might get a little bit extra on the top side or the upside, but you also can get a little bit more negative on the downside. So for me, that's my answer with respect to risk, the difference between high risk and medium risk, and the idea that perhaps you don't really need to be in as much high risk as you may think. Well, I think we've come to the end of the show and answered some of the questions that were here. Again, if you have any questions, you see this show, I guess, online after the broadcast, and you want to ask me a question, feel free to do so. You can always go to my website, send me a message. I'd be happy to answer any questions you would have. And again, thank you for joining us today and taking the time out of your busy schedule. I look forward to seeing all of you once again 2 weeks from today.